is up about 0.5%, 54,318. And the mid-cap index is up about 1%. The small-cap index will come up on your screen, which should be higher as well. So across the board, of course, it's green. And I think all 50 Nifty stocks should be higher, maybe the insurance names, but we'll see. The heat map should tell us that. We'll dive into individual stocks, sectors, etc. Right after that. The reinsurers, etc. are opening higher. Heat map on your screen. What do we have? Okay, not all. IT services and a bunch of others are lower, but otherwise it's all up. And Mahindra, I think, is leading the way once again. 160 points on the Nifty. Surabhi.
Absolutely. And M&M is looking really, really smart with a gain of almost 6%. But I must point out that even insurance, where there's the worry, right now, all insurance stocks have opened positive, including Niva Bupa. Niva Bupa is surging 7%, might I add. The company just told us that overall it's going to be very positive. They will be passing it on to the customers, at least as of now. And they expect perhaps higher value policies and a bigger sum assured to get sold, because people have more money to just buy better and bigger policies. And that seems to be working in favor of the stocks. Anyway, coming back to the Nifty tally, apart from the individual beneficiaries like a Nestle, like a Lever, like an ITC or a Hero Moto, look at Bajaj Finance. The market is choosing to play this through some of the diversified financials. And we know Bajaj Finance obviously has a huge consumer lending franchise. And that stock is the next biggest beneficiary after Mahindra and Mahindra. Then come in some of the big cement names like Ultratech Cement. Nigel's been telling us that overall it's a big positive as well, with the cement moving to 18%. Eicher Motors, Nestle, Lever, ITC, Trent. Incremental gains between 1 and 2% on all of these stocks. And even the insurers within the Nifty, SBI Life is positive, HDFC Life is up 0.5%. So there is no big slam dunk on insurance at all. Perhaps the market had enough time to prepare for this. On the flip side, actually not too much. Reliance is a bit of a drag. It's a bit of a spoil sport this morning, down about 0.5%. Eternal is cooling off. And some of the metal names after yesterday's scintillating performance. Today, the metal stocks, Hindalco, Tata Steel, etc., they're slightly lower. From a 200-point pop, now we're looking at a 160-point move on the Nifty.
Well, some of those hotels as well are doing well. Lemon Tree, that's moving on high volumes, up 3.5%. As Deepan said, Bajaj Finance, well, that could be the ultimate beneficiary, because all the items that you're buying, by taking some credit, well, their GST has come down. So that could be an indirect play. And that's why that stock is up close to around 4%. Solid move on that particular name. Dabur is up close to around 4.5%. So big move out there. Vishal Mega Mart is another stock that's moving on very, very large volume. So that one's up and about. The ones that are under pressure, you have Delta, because the casino entry GST rate has been fixed at around 40%. And Varun Beverages as well. That one is down close to around 2.5% or thereabouts. Ashok Leyland actually is down close to around 2%. That's one of the notable names from the auto pack that's actually underperforming in today's trading session. Pull up Newland Laboratories as well. There was an IC note that had come in from Nuvama with a target price of around 17,700, I think so. So maybe we could get that stock up for the time being. It's up only around 0.5% or thereabouts. But otherwise, autos, consumption themes doing well. The market's holding at around 24,850. You'll want it to hold on to these gains. The market's a net short. It could result in a bigger up move, but you need to hold on to these gains.
Well, that's the thing, right? 180 now, 150 actually. So just about getting things going this morning. We'll get to individual stocks and talk more about this, but let's welcome in Venugopal Gare as well. He's India Head of Research at Bernstein. Venu, good morning. Great to have you with us here. Thanks very much for joining us. Venu, the simple question is, how much is in the price and how much is not across sectors, across mostly consumption sectors? Rates are either flat or they're lower across the board. How do you think about this question? How much will this do to increased affordability as a fillip to consumption? Venu, go on.
Yeah, thanks, Prashant. Everything in life is relative to what it was earlier. So that's a broader principle I use. So if you were to look at consumption in general across the board from a broad-based standpoint, from an economic data points perspective, things have not been that great in the last couple of years, while we've essentially seen the other parts of the economy, including industrials, capital expenditure, essentially being the ones which have led the last few years. Now, what is essentially happening is broadly a forced policy push towards consumption. And this is not the first point at which this is being pushed. We've been sort of seeing the change in theme from the fag end of last year with the direct tax cuts announced with effect from April a $15 billion sort of a positive cash flow to the middle class, which is a recurring annual sort of a cash flow. And on top of that, you have this GST impact, which purely from product standpoint, when we look at the impact is more than $20 billion. I'm just ignoring anything on the services side, which again is a pretty large number. Remember, that doesn't stop at this. We also have pay commission impact, which is a pretty large number again next year. Lower inflation this year in the second half of the year, lower rates, higher liquidity in the system. All of it broadly needs to be factored in when it comes to the potential positivity when it comes to consumption relative to every other sector. So that's the way I would look at it. At the margin, incrementally, the sector would outperform. Quantum-wise, of course, remember that the limitations, if at all, would be the fact that economy in general hasn't been that great. And plus, you have the export impact, which might sort of impact a bit of jobs here and there. We need to negate that as well. So these are the counterbalancing sort of aspects to the extent to which you will see a push.
By the way, I just want to point out that the market today, today's level of the Nifty is a couple of notches lower than where the market closed on the 18th of August. And why do I talk about 18th of August? Because that's when the market reacted to the announcement, Prime Minister's announcement, which was made on the 15th of August. The market that day closed at 24,876, exact number on the Nifty, 876. Today we're at 852. And Venu, that's my question. You know, so much positivity has been thrown at the market. This big, government spent a lakh crore, right? That's the revenue loss from these GST cuts, and there's hope of a good festive season, good monsoons. But why is the market in such a funk? It's simply sort of refusing to see or get too excited about the positives. So what do you think this is? Is it just because of the extent of selling? Or, what's happening here? Why not the kind of, excitement that you would anticipate after a move as big as this one?
The way I would look at it is that the economy has not been very strong for almost a year. Ignore the base effect aberrations and catch-ups, which led to a recovery in the March and June quarters. But on a broad basis, domestic economy has been weak. The second main part is, of course, you're still seeing some concerns on the geopolitical side of things. The overtures India is trying to do with China, US-India relationship spoiling. We've essentially moved to a 50% tariff. After the GST announcement, 2 weeks later, we had moved into that higher tariff rate. So putting all this into perspective, remember that a lot of what is essentially happening on the policy front are offsets to economic weakness. And of course, what we are seeing today is slightly larger than an offset, but the reality is it's only neutralizing some bit of the negative impacts. The other thing, remember, is purely from a flow perspective, there are two main things to note. One is we've not essentially seen EM money or FII money essentially too excited about India. Part of that is because there were great opportunities elsewhere. And more importantly, economically, things were a bit more weaker, along with valuations being higher. So that is something which needs to reverse in the second half of this year for you to see markets to go to higher levels. And we do believe later in the year it would, because once all these moves essentially lead to an improvement in the economy is when you essentially see FII money flow in. And whatever domestic money is flowing in, you're also seeing the IPO pipeline as well accelerate. So there's a lot of selling as well happening in both the primary and secondary markets, which is sort of digesting that bit of a flow. So it's a combination of all that. I wouldn't really worry too much about it 6 months from now, but don't expect any immediate gains just because of this move.
Hi, Venu. Good to see you, Ben. But it's encouraging to see at least the center taking note of the slowdown and acting on it. And monetary policy as well has been pro-growth. So I think both those two at least, they acknowledge the problem and trying to do something about it. That said, the two big beneficiaries, going by the reactions on the stocks, going by what most brokerages are saying as well, autos as well as FMCG. Now, FMCG actually, the staples part of it has underperformed. How do you approach that pack? What do you like from FMCG, the discretionary spend, or do you think staples as well, you'll give it a look? And from autos, which category do you like?
Okay, so, on an overarching basis, when we headed into this year, we had a change of view in terms of how we positioned our sectors. So this was the first ever year where we had consumption overweight on a broader basis relative to industrials. Now, within consumption, FMCG as a space, I had upgraded about, I would probably say 1.5 to 2 months back. And that is a sector which is essentially underperformed for a fair bit of time because of volume growth concerns. This is a space, I guess, given what has happened to GST changes today, is a positive surprise, honestly. I didn't really expect some of those categories to move to 5% rate, especially when things like shampoo, soaps, I thought probably it'll be still at 18. So it is a positive surprise. So FMCG pack in general, I guess, still has some legs because it's not really done well in the last couple of years. Within the small value discretionary, I think we shouldn't miss out on that fact, which is durables and other areas. Ideally should also see some degree of lift in terms of demand. Remember that just because a consumer is saving, let's assume the $20 billion number based on whatever he was purchasing earlier, that money doesn't need to go into the same sector. That could perhaps be used for buying any other product, or maybe even invest or repay debt, whatever. I mean, from a quantum standpoint, one can discuss. So that is a very important factor as well when it comes to taking an overarching view on consumption rather than a particular category. Yeah. Coming to autos, very clearly, it's a benefit across the board for ICE players versus EV, because the gap between EV and ICE tax rates are narrowing. And within ICE, we've been in general positive on small cars, which has essentially seen a run. We're also positive on the tractor sort of slash SUV space. So these are relatively more preferred rather than an entry level motorcycle, because we do believe that wherever penetrations are lower, there'll be a larger propensity to see a broader volume impact, as against sectors where penetration is already high. You should ideally see a lower impact in terms of volumes. So that's a broad way I would put it.
I just want to quickly highlight that if you look at the auto space, right, it is Mahindra at one level, everything else is far below. Eicher is also just up about 2.5%. Mahindra continues with its 7% pop, not very much else really in a big way, which is sort of starting to show through.
And on auto,
yeah.
The actual beneficiaries, or the ones that were supposed to be big beneficiaries like Maruti or Hyundai, the stocks have also not moved too much. Those stocks are up between 1.5%.
So it's a sad thing, but as someone said, and I think it makes sense, right? That like at the lower end of the EMI difference, for example, a Alto or the entry level kind of cars. The EMI difference is so small, it's actually a few hundred rupees on a typical auto loan. So if you could not afford a EMI, for the entry level car before, would a few $100 make a difference to push demand?
Yeah.
Right? That's the. I think it's a relevant question to ask. Hopefully it does, but I don't know. Yeah.
No, absolutely. And in fact, I was going to ask Venu exactly about this, about financials and the way we need to think about it. Because, of course, Bajaj Finance is a clear beneficiary straight out. But overall, on financials, would you expect...
I think Venu wants to say... Venu, you want to add something? I can sense that you want to come in. Go on, Venu.
I just loved your comment on the quantum of EMI impact. If you were to extrapolate this to every product category, then there's going to be zero impact on anything. So a 20 rupees soap, why should somebody buy? Because it's 2 rupees cheaper, right? So I think we need to look at it from a broader context of...
No, you're agreeing with me, or you're being sarcastic, Venu?
I'm being sarcastic with you, not on the market.
Sorry, what is that?
I'm being sarcastic on your comment rather than on the market and the benefit. I do believe you need to think of need to look at things from a very holistic overall impact perspective, right? So this $20 billion number is, I don't want to nitpick on particular categories. Honestly, 100 to 200 rupees saving is very meaningful for a particular individual who's buying a two-wheeler. Yeah. A 5 rupee saving might be quite meaningless across the board on a soap for anyone, right? So, but the saving is a saving, right? And it's going to feature somewhere in terms of some incremental volumes. That's the way I would probably present it. And also remember, Prashant, that Maruti...
No, Venu, my point, the point is, you're aggregating all the savings, and that is saving in the hands. It'll go somewhere. But my only point was, can you say this segment is where it's going to see a bump up? I mean,
Exactly.
That was my point.
That
So
is
for
exactly
entry-level
what I
cars,
had.
will demand go up significantly because you got a couple of hundred rupees in terms of EMI
But
savings?
the price of the
that
car
I'm not sure.
itself is
Exactly,
down 10%, right? We have to take that on board as well, that the price itself, if it's passed on entirely, like M&M said, the price of the product does go down by 10%.
That's what I'm saying.
Yeah.
But calculated as EMI.
As EMI.
It's 700-800 rupees.
Yeah.
That is my point. I'm saying, will it really move the needle for that product category? I'm not sure. Go on.
Prashant, fair point. In fact, just a couple of minutes back, I had commented this, right? Saying that a saving in a particular category does not mean you invest in a particular category. You would
Exactly.
probably invest in saving somewhere else, in
Yeah.
any other category.
Yeah. That I agree.
So-
Completely. Yes. No,
That's
I think we're
Also remember that stock prices have moved very differently. Maruti had moved ahead of this particular announcement quite materially. It was below 12,000 rupees just about a month back.
That is
Right?
true.
So
That is true.
think of that fatigue as well, right? And
No,
M&M
absolutely.
had not moved much 2 weeks into that previous GST announcement after the Independence Day. So maybe that is the other aspect to look at it. Plus this incremental thing is tractors also have happened.
And-
so that is also playing more as a positive sort of a spirit.
No, absolutely. And everything doesn't need to happen on day one when you take that point. I mean, the manufacturers themselves have told us, right? This will eventually play out. They'll ramp up their production and they'll see what the debate that you and Prashant are having, I think we'll have exact clear answers within 2-3 months on whether the customer behavior starts changing because the headline number of that particular vehicle itself is down by 10%. But I just want to get back to the point on financials. Whether we should look at beyond something like a Bajaj Finance, whether we should look at banks differently. Do you expect a leg up in financing to show up? And if yes, across what kind of lenders?
Yeah, I mean, honestly, the financial sector is in a situation where credit growth has been fairly weak. In fact, deteriorated all through the beginning of this year. As you see the second half of the year, there are clear positive signs of why credit growth should improve. We're essentially seeing a lot of liquidity come in the system. And more importantly, I think the regulatory system is more or less keen on pushing up consumption leverage back again a bit at least, or leverage in the economy a bit more, right? So these are all positive signs. You want to play it through a bank, you want to play it through a pure play durable lender, or you want to play it through, let's say, even things like affordable housing companies. It's across the board. You can pick and choose where you're more comfortable from a valuation standpoint. See, I'm on an overarching basis overweight in financials, apart from my consumption overweight here and there. And as you know, I'm underweight industrials in other areas. So I would be probably playing a bit of financials as well from a standpoint of leverage.
And which category? I mean, spell it out. You just named a couple of them, right? But where is it likely to show up the most? Specific niche NBFCs catering to consumer, housing, what, where would you really expect the impact to be?
Exactly. The consumer parts of each of these entities. Some companies would be more, NBFCs would be a bit more leveraged to that. So they'll probably benefit a bit more than an overarching large bank, which is doing a lot of other things. But then my call in financials is not purely linked to GST and consumption. It's more led with overall credit growth improving from where we were earlier. So it's tough for me to, remove myself from that broader thought process of overall credit growth and not just consumption-led credit growth.
So financials, right, where economy, the financials are lenders, they're economy-facing, and so you don't have to choose. I don't know, you can't pick stocks, but I'm saying something like Bajaj Finance, right, consumer lender. I'm assuming with exposure to multiple sectors, but on the consumption side. So it should show up in those kind of names.
Yeah, I mean, look, it's all about relative growth as well, Prashant. So if something is growing 25, it goes to 27, does it really lead to much impact versus something growing at 8-10% credit growth going to becoming 12? I guess the impact is much more for that, right? So it's you can't basically take a particular stock and say the impact is only going to be on them.
You're being very cryptic today. We'll need to. We'll.
I want to avoid
You're saying this and that. But anyway, we'll leave it there and we'll talk again and come back and we'll talk again. We've got lots of GST companies to talk to as well. Appreciate your time here as always, Venu. And thanks very much for joining us as always. So that's Venugopal Garre, Bernstein, with his perspective. We spoke with the top management of Mahindra & Mahindra. That by far is the biggest gainer on the Nifty. Anish Shah, Rajesh Jejurikar. Listen to what they told us. Basically, every part of the portfolio, according to the Mahindra management, will get a leg up. Listen in.
Ushers in a new era of simplification and possibly a new era of ease of doing business as well. it will have a very significant impact on consumption. And this is something that should, in some ways, create that momentum that we were looking for in the economy. A lot of the fundamentals have been in place, but I think this is a very significant move that will create that momentum and propel India to an 8 to 10% growth rate overall. So that is the reason why we feel it is a very important milestone for our economy and sets it up in the right way.
Tractors gets a big boost, 12 to 5%, which will lead to prices coming down 40 to 60%. There is limited time to capitalize the upside in the festival period. We are literally 20 days away from the festival period. We can't increase capacities or production outputs. Festival period is a 30-40 day period. So I honestly don't think we're going to get a wholesale billing upside in the short run. This is more a long-term game.
Okay, that's a take from Mahindra, and Mahindra stock is still looking rock steady and solid, 6.5% higher. Overall, the Nifty, it dipped to about the gain being a 150-point gain, but now again you're seeing a second wave of buying come in, and overall it's looking really good. A lot of consumer stocks, by the way, Nestle, there is ITC, there is Lever, there is Trent, plenty of names. Actually, let's look at some of the others as well, like Dabur. Yeah, Dabur's up 3.5%. So many consumer names on the upswing. Colgate 4%, and I named some of the others as well. In fact, on that note, let's bring Mangalam back in to look at specifically ITC to understand, because it has lots of different parts of the business. For some, obviously, the rate goes down, but what happens with tobacco? So overall, what does this mean for ITC, Mangalam?
Well, from all the details that we have so far, it looks like it is a positive for ITC, and here's the reason why. Because if you look at the current cess and situation or taxes on tobacco itself, it is 28% GST, plus there is a specific and ad valorem cess, which totally amounts to about 53 to 55% of the MRP of a cigarette that one buys from the street. What is proposed that this compensation cess will actually be subsumed. This 28% turns 40%, and GST will be 40%, which will be charged on MRP versus the transaction value, versus what it is right now, 53 to 55%. The government has said it will be tax neutral. So what this means is that we need to know whether the NCCD or the National Calamity Contingent Duty continues or not. If that does continue to the rate of around 10 to 15%, that means it is absolutely tax neutral. And that is what the analysts are expecting. So no increase is definitely a positive. The second part is that a large part of their other portfolio, the non-tobacco portfolio, FMCG staples products, they've been bought under the 5% slab. So that's positive for the volumes out there. And then they also get a fair amount of revenue from notebooks, the ITC Classmate business, and that the exercise books, notebooks, etc. have been brought down from the 12% slab to nil. So the tobacco portfolio, there is no fear of increased taxes, and the other portfolios, there are lower taxes. So all these, with the fact that the stock is trading at around 25, 26 times 2-year forward earnings, makes it stand out in terms of beneficiaries from the GST rate rationalization.
Okay, all right. So ITC climbing on the back of all of that put together. So net, nothing negative. And in fact, incrementally for some of its businesses, including FMCG, notebooks, etc., there are incremental positives coming through. However, AC stocks are actually, slightly under the weather, can I say, because there's not much of a euphoria. Voltas is down about 0.7%. Blue Star is up about 0.3%. Though, of course, there has been there's been a build-up. So if you look at a longer-term chart, let's pull up Blue Star, and if you see, say, a 6-month chart or a 1-month chart, this week itself, going into the GST meeting, there was a little bit of a, so there was a bit of a pop that showed up. The question is, what happens from now? Because the GST cut has indeed come through from 28%. ACs, washing machine, a whole range of consumer durables, television sets, everything has moved to 18%. So let's discuss this. We have Mr. B. Thiagarajan, Managing Director at Blue Star, with us. Mr. Thiagarajan, thank you so much for joining in. Now, very interesting, right? I remember all our conversations. It was a rough start to the year with a washout, monsoon season, tough first quarter. But now you've got a big bonanza coming in from the GST Council. So help us understand this, sir. I mean, but, ACs are also, it is also a seasonal business to a large extent. What is the immediate implication? Do you expect any sales in the festive season? Because some parts of the country, including here in Mumbai, I mean, October can be fairly warm. So, what is the impact near term and then medium term?
Good morning, Shirbi. It is a pleasure interacting with you. So as we had discussed, the summer season was bad. But whenever summer season is bad, the festival season always does well because of the latent demand. So one would have anticipated 15 to 20% growth during the festival season. But when the announcement was made on August 15th, as you can imagine, the consumers would wait it, and they have been waiting. I think they will wait till September 22nd. Rightfully so, they are entitled to this benefit. So I anticipate that from September 22nd onwards, till the new year, it should be a great season ahead for multiple reasons. Significant reduction of around 10%. It is anywhere between 2,500 to 3,500 rupees, depending on the model one wants to buy. And never in the history there had been such an increase through one announcement. There is a energy label change that is coming up on 1st January 2026. Therefore, there will be a rush to purchase the products before the prices go up. And the third part is that there will be significant amount of shift in the consumer behavior. Someone who wanted to buy a 3-star will end up buying a 5-star. Someone who wanted to buy one air conditioner may even consider buying 2. So therefore, this is a period. You see, also I must tell you, the disposable income is going up on number
Right.
of friends actually.
Oh, absolutely, absolutely, because there are savings across the board. I mean, depending on apparel, etc. So we'll need to see where the consumer really decides to spend more, and it might be different for different categories. But sir, you said that earlier you were working with a growth of 15 to 20% this festive season. Now with the cuts coming through September 22 onwards, what is your estimate for festive season? Could it be higher? Could it be 25 to 30%?
It should be higher, but not in Q2, but if you take Q3 together. See, I will also tell you, we had shared the figure that even though the summer season was washed out, the year began with an expectation 25 to 30% growth in FY26 is possible.
Yes.
But when the summer season had been a washout, we felt that 10 to 15% growth only is possible. Now I would say the industry can look forward to even 20% growth for the full year. And it is indeed possible, even though the summer season was a washout.
And how much in the festive season, which largely is going to, fall in end September Q3, but again, festive to festive comparison, earlier you were expecting 15%, 15 to 20%. What's your expectation now?
I think it will be 30. I mean,
30%.
Okay. Generally in India, when an announcement is made like this, there is a huge rush. And this will indeed be taking place. And the intention here is to pass on the full benefit to the consumers, right? And that's what we will do.
All right. Hi, Mr. Thiagarajan. Clearly, you're sounding quite optimistic about how things will pan out from here on. But I just want to ask you how the 20% GST in the current inventory will adjust itself?
Nigel, an intelligent question. So there are products which the dealers have bought at 28%.
Yeah.
If the rate would have remained unaltered, there is no issue. But here he will have a higher input tax credit. It is not only air conditioner, the GST rate has dropped across consumer durables. So therefore, the dealers will have a working capital burden. We have done the calculation, possibly for about 2 to 3 months they may have the burden. And there is some compensation that may have to be considered in terms of that interest burden they have.
So then near term, it will be a bit of an issue for those that are already sitting on that inventory, right?
In our case, it is around 30 days more than what is required. That is an inventory. But that's manageable. See, nothing in life comes without going through some hardship, right? But I'll tell you one more thing. The entire portfolio, the demand planning will change, right? We would have planned for certain quantities in October, November, December. We have to wait and watch and produce more. The next part is connected with, there will be a significant shift. A person wanting to buy a 2-star will end up buying 3-star. Yeah, some other brand someone want to buy may buy a premium brand. And a 3-star buyer may ask for a 5-star. So there is going to be some work to be done in order to reap the full benefit of this reform.
Okay, got that. We'll leave it there, sir. Thank you very much for joining us. It's a pleasure and very sort of good insights in terms of how this may play out for the AC sector. So there's a clear bump. There could be upgradation in terms of aspirations of what people want to buy, the kind of ACs, the number of ACs, etc. on the back of this. We'll take a quick commercial break here. We'll be joined by the managements of Poly Medicure and Metropolis Healthcare on the other side. We'll talk about, of course, the impact of GST. Poly Medicure, of course, has also made an acquisition, so there is that as well. Coming up.
Welcome back. Well, GST on medicines have been cut from 5 to 5% from around 12%. In fact, GST is reduced to 5% from 12% for diagnostic kits, blood glucose monitors, various devices, bandages as well. We're now joined by Himanshu Baid, the Managing Director at Poly Medicure, as well as Ameera Shah, Executive Chairperson at Metropolis. Hi, ladies and gentlemen. Good morning. Thanks a lot for joining in. Well, Mr. Baid, coming across to you first, you've also done an acquisition. We'll talk about that in just a bit. But, duties coming down should spell good times for your business. I think a third of your business comes in from India. So tell us your reading, what kind of a positive impact it could have?
I think, we have three different structures, 5%, 12% and 18%. Everything gets collapsed to 5%. So I think this will spur demand, especially for essential healthcare products, so especially used in, home care, area like thermometers and glucometers and all that. And for hospitals, the cost for medical devices will come down from, let's say, because of reduction in GST. And as they are nil rated, so they don't get any benefit for higher GST rates. So as the GST comes down, I think the cost of treatments for patients will also come down. So it's very, very positive for the industry.
Okay, all right, got that. We'll try to get some numbers out of you, Himanshu, in just a bit. But Ameera, coming across to you, diagnostic companies, well, they should benefit because of lower capital cost and lower raw material cost as well. Do you believe it's a possibility you could quantify it, in terms of basis points, the outlook on the whole?
See, this is a landmark reform that the government has done, and frankly, at Nat Health and obviously from all of us, we've been pleading with the government for a long time, saying because we don't charge GST to the consumer, we have all these input costs with no actual offset. So this actually gives an opportunity now to to be able to have a lower GST input cost. Because medtech has come down and reagents and chemicals, the GST has come down from 18 to 5. That will certainly expand access for the industry. It will create a fairer competition playing field between the unorganized and the organized. And also, as Himanshu mentioned, the rates were all across the board earlier. I think that will definitely aid in ease of doing business because you have now one GST slab versus multiple. And the biggest one, I think, which is the most beneficial for consumers, is that with insurance, GST coming down from 18 to 5, as well as from, like you said, glucometers and other areas, this actually is a direct benefit to customers, right? It significantly makes it cheaper for them. And I think it'll really expand access to health insurance through this.
Ameera, on diagnostics, will we see price cuts price reductions for consumers on tests, etc.?
It's difficult to tell because diagnostics has already been obviously a very, very competitive pricing already because of competition. You have to remember that GST was not really applicable to the consumer at all. It's only on the input cost, and that also not everybody in the industry has actually been bearing it. So actually, more than anything else, it will create a little bit more of a fairer platform for people. And hopefully it will create a better sustainable healthcare ecosystem where you can make more investment in the industry.
Amira, just to understand, now for any diagnostics lab, whether it's surgical equipment, gloves, consumables, I think bandages also. So on a lot of these items, testing kits, and on a lot of these items, the GST gets lowered. But as customers, we don't pay individually for these items. We just pay for the cost of the test. So how will the benefit be passed on to the customer?
Like I said, it's difficult to tell at this point of time. Like I said, there's two different separate, right? On the retail insurance and on the glucometers, there's a direct benefit to the consumer, right? Because the consumer was paying 18%, now it's 5%, there's a direct benefit. In this case, it all depends on whether the hospitals or the buyers of these reagents and chemicals are able to see benefit in their P&Ls and are therefore able to pass on part of it. You have to remember that the organized sector or the ethical organized sector, which was actually paying GST, was making significantly lower margins than obviously the sector that was just not paying GST at all, which was actually majority of the sector. So this actually creates more of now a level playing field versus anything else. So whether or not you're going to land up seeing a big, dip in prices is very difficult to tell at this point.
So if there is no dip in prices across diagnostic chains, then there should be a margin improvement. Either one has to happen.
You're right. Either one has.
Yeah. So should we expect better margins for Metropolis or for the overall industry if there is no cut in pricing for tests?
It really is too difficult to tell at this point because I think the news has just come out. I think everybody will have to go back to their companies and really look at what is going to be the impact for them and what is going to be therefore a potential benefit that could be created for the consumer or whether it's going to be a margin expansion. I think it's, I think the next 15, 20 days, everyone will do their own analysis and make their own courses.
Okay. All right. Let's come back to you, Mr. Baid. Then you have done an acquisition in Europe as well. You've done it at roughly EV upon sales. I think it's around 2 times. What's the plan with regard to this acquired business? It was doing around 10 million euros last year and I think around 1.5 million euros of EBITDA. How do you see this business scaling up?
See, Nigel, if you remember, we started our cardiology business just a few months ago. And to scale up globally, this was the best option for us because this company has all the regulatory approvals needed to sell products in Europe and also it has a US FDA approval. So this gives us a leverage to enter the European market very quickly with our products. And also we'll be able to, get synergies and cost savings and R&D benefits across both the companies. So this company is also, doing R&D on some cutting edge technology. And some products are going to be launched in future also. So all in all, I think it gives us a huge strength in the cardiology business going forward. And we are looking at it as a strategic asset. And again, there are a lot of synergies in distribution network. We can leverage our network, global network. We can leverage their network. And there are a lot of partnerships coming with this acquisition. So this will help a lot in the long way.
Sorry, what does this, Himanshu, what does this allow you to do, Pendra Care Group?
See, they are in interventional cardiology there. So basically, guiding catheters, diagnostic catheters, using angiography, angioplasty. So these are products we have just recently launched in India. So we get a, full, range of products which is already established in Europe. So we don't have to go through clinical trials. Or if we had to go through, we would have waited 3-4 years for this. But now we have a direct access into the market immediately with these products, and we can help them to reduce costs also, and help up improving the margins. And also, whatever we are developing in India, this will become our let's say, our springboard for the European market.
It's doing margins of around 15% right now. You do higher margins. So do you see in the next 2-3 years you're trying to bring this acquired unit, at par with what you are doing currently? And from around this 10 million euros, where do you see it headed? What kind of pace of growth?
So we are looking, Nigel, when the synergies kick in, we are looking at margin improvement, maybe 2 to 3 million euros of, let's say synergies coming through margin improvements across both the companies. And then if you look at the growth rate, let's say by 2030, we should look at, a growth rate, number close to around 25 million euros for this company in terms of revenue. So maybe a CAGR of 23 to 25%.
Okay, well, those are good numbers, which I think we'll watch out for. Himanshu and Ameera, thank you both for joining us. Really great to get those insights from the both of you at this point in time. So that's, medical equipment business and, of course, healthcare on the diagnostic side, getting you a sense of what's happening. 200 points, by the way, on the Nifty. We're at about 24,915. I think we should just look at what's happening in the market in terms of stocks, etc. as well. I think right up, we were talking about Bajaj Finance with Venu earlier. Bajaj Finance is the top financial gainer, 5%, completely consumer-facing. It's up $40 on very large volumes. Mahindra & Mahindra continues to be the top gainer across the board. It's actually M&M and Bajaj on the NSE, number 1, number 2 volume-led gains. Escorts is not doing badly at all, almost 7% at the number 3 spot. And they've got a bunch of these FMCG names. Britannia I can spot, Colgate I can spot, those are the others. Bata is up 6%, Bata India. So 1,230 coming through on Bata. Campus Footwear is up about 5.5%. We'll try and speak with some of these footwear companies on the GST impact as they see it as we go along. PG Electroplus, we just spoke with Blue Star. PG, of course, it had that big issue. And with regards to guidance, etc., they were talking about the huge inventory, industry and PG-specific inventory in the system. They said, well, it'll clear out in the normal rate only by about November, December, late this year. Maybe this helps in clearing out the inventory faster, but they'll, of course, take a hit on some of this inventory because it's priced higher, taxed higher. Godfrey Phillips is up 5%. Right now. And one name from yesterday, right? NetWeb was limit up yesterday. It's up another 6.5% at this point. So, there is a lot which is going on with regards to this. Actually, the other one is E2E, similar kind of space, 4.5%. E2E was also limit up, circuit up yesterday. So gains are showing up here once again. Surabhi.
As a woman and like most women who love our shoes, this is great because now if something was priced at, say, 2007-99 or 2008-99, the companies perhaps will have a lot of incentive to move it to under 2,500 to get the lower GST, which actually, let's bring in Mangalam on this because look at Metro Brands, look at Bata itself. Campus anyway has been, a lot of its offering is under that price point of 2,500. But the shoes are walking, and so is the rest of the FMCG sector, Mangalam.
Well, the shoes are running right now, and rightly so, because, what was earlier 1,000 rupees has now been increased to about 2,500 rupees in terms of a ceiling. And remember the important part, that majority of the organized footwear industry in the country, no matter the prices that we pay for our shoes, etc., is sub 2,500. So in terms of volumes, this number subsumes nearly 95% of the footwear volumes in the country, and a large chunk of volumes coming in for the likes of Bata, Relaxo. In fact, nearly all of Relaxo, or nearly all of Campus, etc., would be under 2,500 itself. So this stands to benefit all of them. The only fly in the ointment would be for the ones who are looking at premiumization, so the kinds of Metro Brands, etc., where the average selling price is a lot higher than 2,500 rupees. They may have to, either take the price down to 2,500 rupees or bear a bit of a dent in terms of higher GST or no change out there. The important part, but from an FMCG standpoint, I heard Prashant speak about two names, Colgate as well as Britannia. Two things are common between them and the GST rate coming down. The first part is that for Colgate, nearly 95% of their portfolio stands to benefit and come at the 5% mark itself, because it's toothpaste, toothbrushes, etc., all of them down from 18-12% to about 5%. So that's a positive. Even for Britannia, we have nearly 85 to 90% of the portfolio, which includes the likes of biscuits, cake, cheese, rusk, etc., down to about 5%. So these are, standout beneficiaries in terms of portfolio weightage or portfolio exposure to the rates which have now come down to 5%. But the second part is both these stocks saw a big gash post their first quarter numbers as well. So there was also headroom for an up move on both these counters. And these are also products which are more sensitive to prices because, in the Colgate form, the premium products, etc., which have been doing well. So mass consumption, there was a problem. There was a fair amount of competitive intensity. So prices coming down out here or perceived value increasing could boost volumes. And even the case for Britannia as well, 5 rupee biscuits, 10 rupee biscuits or 15 rupee biscuits, all of them are the ones which are most impacted by any slowdown in consumer sentiment and will benefit the most when there is a price benefit that comes by in terms of consumption as well. These are impulsive purchases, so there could be some volume increase or volume growth that we can see for both these counters.
Okay, all right, got that. Mangalam, thanks very much. Let's quickly get back to the auto space as well, because the biggest leaders of the rally are probably some of the auto names like Mahindra and Mahindra. We have Sud back with us. M&M really revved up, Sud.
So big GST reset, and the biggest one of the biggest beneficiaries, the auto sector. In the auto sector, also 3 segments which are the biggest beneficiaries. First, tractor segment, second, SUV, and third is EV. And that's the reason screen is telling you why M&M is top Nifty gainer. Even stocks like Scott's Kubota, Swaraj engines, which are mainly to tractor segment, are up almost in the range of 8 to 9%. Now, what did GST do? GST Council has approved reduction across the segment. So small cars, motorcycles up to 350cc, auto parts, all these segments come in the slab of 18% versus earlier tax rate of around 28% plus cess. So smaller cars beneficiaries include Maruti, Tata Motors and Hyundai. Auto parts beneficiaries include Bell Rise, Endurance Technology and these companies. Even Tire also comes in the 18% slab, and that benefits companies like Apollo Tires, Seat, Balkrishna Industry and so others. Tractor has come to 5%. And that's the reason M&M is up. And also tires and the other parts which are used in tractor segment, that also will come in the 5% slab. Apart from that, EVs remain in the 5%. Then tanks and other armored vehicles. So of that, Tata Motors, Ashok Leyland and Bharat Forge are the biggest beneficiaries. Then high-end cars move into 40% slab. But it's very important. Now, even after moving into 40% slab, effective tax rate would be lower than the earlier rates. Because earlier, for example, XUV700 of M&M, 28% was the tax rate, plus 22% was compensation cess. So that's the reason effective tax used to be in the range of 43 to 50%, which now comes down to 40%, and that will benefit companies like M&M and also Maruti, because for Maruti also now almost 30% of total volumes come from SUV segment. Even Maruti is benefiting from small car reduction as well. Now for bikes, so up to 350cc reduction will benefit all the companies. So in this, biggest beneficiary is Eicher Motors, but there is a catch. For Eicher Motors, 11% of total volumes have the capacity of more than 350cc. Now, surprising factor has come because earlier tax rate used to be 28% plus 3% compensation set. Now that has increased to 40%, so that is minor negative for Eicher Motors. So overall, it's positive for auto with minor few negatives.
All right, super explanation and great stuff there. Thanks very much, Sud. The sector is excited, and so is Sud with what has been done. So lots of reactions. We spoke with Mahindra, more coming up through the course of the day. We'll slip into a quick commercial break, and we come back once again and focus on the insurance space. PB Fintech's management will be with us. Shriram Finance is another management we will be speaking with on the sweeping GST changes which have been made. Stay tuned, coming up. Welcome back. We're now joined as promised by Umesh Revankar, Executive Vice Chairman at Shriram Finance. We also have Yashish Dhaya now joining us, Chairman and Group CEO at PB Fintech. We've been, of course, talking to a range of businesses, range of companies, and asking them what the GST cuts do for their specific business. Mr. Revankar and Yashish, great to have both of you here. Yashish, if I can start with you. We spoke with Niva Bupa earlier, and the understanding is that while this is great for consumers because that 18% goes away, from a insurer's perspective, companies are kind of circumspect because without the ITC, the input tax credit, will this actually lead to a slight increase in cost? And we put out some of these calculations earlier with Yash over the last fortnight or so in terms of feedback from industry. So looks like it's come to pass. I just wanted your thoughts as a as a platform. I'm assuming this does increase volumes for you. You're not, in that sense, affected by this. Go on.
So we are super enthused by this move. I think it's a great vindication for us because for the last 17 years, we have been saying protection, which is health and term, are the most critical products for the consumer. And the government acknowledging that and the government taking the GST away on those products is a very, very strong message. So I think none of us should miss the wood for the trees here. Whether there's a couple of percentage points of input tax credit or whether the price goes slightly below or slightly above, that's all fine. But the great message is that health and term, separated from many other products, are very, very critical for the consumer, and the government is not going to charge any GST on these two products. And thus, the consumer will definitely benefit, but more importantly, the message will get home that, look, these are important products supported by the government. And I think that is the key part here.
Yeah.
One can go through the mathematics of, look, think about it. In health insurance, a consumer can pay on monthly mode basis. And, there is the person can change the moment the transition happens. So I don't think there is any big difference. And yes, if there is some cost, I'm sure that there will be a discussion that the insurance companies will have with the regulator. See, the second point I will try to make is investors and analysts have read through most of this. And if you look today, almost everybody universally, whether it's LIC, whether it's HDFC Life, whether it's ICICI Life, whether it's Niva Bupa, whether it is Star Health, whether it's ICICI Lombard, and whether it is us, everybody's price across the board is up. That means people are seeing something positive. So I think the big message here is very, very positive.
Yeah.
And I don't think one needs to get too embroiled in the
couple of percentage points. And I think you put it well, woods and trees. But I just, with the forest. Yashish, just a quick point. As on a practical basis, health policies, for example, again, if I can use your analogy, a few percentage points of the abolishment, will this help in increasing penetrations? I mean, I don't think you're saying that somebody is not taking health insurance because you got to pay 18% GST. So, but
I don't think there is any consumer out there who was not buying health insurance at 10,000 rupees and just because it is 9,000 rupees will rush to buy health insurance.
Correct.
So I don't think it is about that.
Correct.
I think the bigger part is the message. The message is that this is very important for you. Even the government does not charge GST on it. And this is a very important product for you. And similarly, and even more importantly for term insurance, please appreciate this is the first time that term insurance has been carved out in a way, or something specific has been done for term insurance. Please appreciate it's a very small part of the overall life insurance industry is the pure protection element. And this is the first time that the pure protection element is being called out as term insurance is very important for you. The government, which used to charge 18% GST on term insurance, will not do so from 22nd of September. It's a very, very critical message. And I think that message should not be missed. And I think that message will go a long way in amplifying the importance of both term insurance and health insurance to the consumers.
No, absolutely, Yashish, take your point. It's a big, big step for policy buyers. It's a huge relief, right? And this is what we were discussing with Niva Bupa, with Ankur, just a while back. That, now that as a policy buyer, since I have the additional cushion, maybe I'll buy a bigger policy, bigger sum assured. Maybe I'll buy a more higher value-added policy. But the question here is that unless there is a tweak and this input tax credit business is resolved, who bears the brunt? Who bears the pricing? Now, one company we spoke to said that we're not going to be, and you're a big sort of player in the entire ecosystem. So could some of it come to you as well? What happens in the interim? There's this 18%.
I think totally missed point, I would say. Really focusing on an irrelevant matter compared to the big matter. I think for us, it's a question we haven't even thought about, and it's perfectly fine if there is a plus or minus that happens on that. The clear message that you can see both from the markets and from us is that this is a super positive move for the messaging. I do not believe, unlike what you just mentioned, I do not believe a customer buys a policy because it is 10% more expensive or 10% less expensive. I don't think that is the reason at all. I think it's the messaging which is very important. That look, health insurance and term insurance are very critical for you. And I think as long as we focus on that, and if you look at, and that's what I said, right? If you look at the markets are rewarding everybody today.
Absolutely, because the larger point, like I said, and we've discussed that as well, we've highlighted that largely when the price goes down, you will insure more, you will buy more, because that need has been well understood. Coming back to you, Yashish, in just a second, let me also bring in Mr. Revankar into the conversation. So, morning, great to have you on. So the market is also very excited about all the financiers, right, who will be catering to whether it's auto demand, whether it's consumer durable demand. As of now, what do you anticipate? Third quarter, basically September 22nd onwards, when these cuts kick in, what can be the additional boost to the lending for you specifically on the consumer side of your business?
Yeah, thank you. What I believe, I agree with Mr. Yashish's view. It is the sentiment and messaging is more important. I think a positive sentiments and the messaging done will create a demand. That demand is not just because of the pricing point. Pricing point is not important. It is what is essential for you and what it gives you back. So I think the positive environment and higher economic activity will bring in more business. I believe the third quarter is likely to be much bigger compared to even the previous year third quarter. And because the sentiments will be much positive. And I think the environment can reinvent itself to a higher consumption.
So, sir, some indication, third quarter, what is the growth in disbursements, overall AUM, what will you expect given this big bonanza?
I do expect, we have been planning for 15% growth year on year. We should be able to grow maybe a higher number at 17-18%. It all depends upon economic activity per se. But I think definitely we will cash on when the sentiments are better.
Mr. Yashish, this is Yash Jain. I want to come to you. You, of course, spoke about, not missing the forest for the trees. Clearly, it is a very big positive for policyholders, but, just not missing the shareholders for policyholders also. And from the shareholder point of view, I want to understand something. The government, of course, is clear that profiteering shouldn't happen after this cut, which means the benefits of that 18% cut when it comes to GST should be passed on to policyholders, which means our calculation suggests that about 5 to 7% of cost will come to insurers on health insurance and about 10 to 11% of cost will come on term life insurance. Now, if profiteering can't happen, then cost will, of course, have to be shared between the insurer and the aggregator like yours, because commission is still not exempt, which is paid to you. Can you help us understand this thing, how it will be shared between the two parties if it can't go to the policyholder? And second thing, I just want to understand what happens thereafter, because you said that volumes won't go immediately after this cut, right? Insurance is not a product like that. So is it a double whammy in the sense that volumes don't go up, at the same time some additional cost comes on your books?
Yash, every time I speak to you, I love the focus on commissions. Do you know how much profit we make? We make 1% of premium as our profit. Is that too much? 1% of premium. That is our profit. Right? Is that too much? for everything we've done for the last 17 years. And our accumulated company is still in losses, right? Yes, when we do 1 lakh crores of premium, of course, 1% will also be quite a bit. But it is 1%. That is what we make, right? So it is not like one is making too much money or anything of that sort of profit. Terms like profiteering, etc. do not. Which insurance company is making crazy profits? And which distributor is making crazy profits? Right?
Yashish,
But sir, the
Yashish, if I
point
can ask
is
you,
that it will have to be shared, sir. Sir, it goes back to...
Let me just finish off on that, right? If the benefit is 18% and the cost is 5% or 10%, a benefit is going to the consumer, is it not? Right? Whatever the...
No, correct. The benefit is going to the customer, the policyholder, definitely. And that's what I started with. But what happens to the company also? That's also important for the shareholders.
And you are already seeing the company reaction. There are people who are smarter than both of us who are actually investing. And they are all giving everybody a 3 to 6% increase in share price. So that means there is some benefit that we are missing. That is actually going to the insurers and the distributors from this. And that is the benefit of the message. You know, whether you look at Star Health, whether you look at Niva Bupa, everybody's up today. Nobody is down. Neither is...
Yashish, you surely are not. I know that you're not the one to look at stock prices and make determination.
No, but
today you're doing that.
It is an indicator of what the investors are thinking.
Yeah, no, I completely agree.
And Yashish's point... reaction is. So I think we are very stuck on one point. Input tax credit,
it is. We began by saying this is absolutely great news. When I renew my policies, I will pay less. I'm delighted. And I think most people...
Tell me one thing. Would you buy a policy or not buy a policy because it is 5% cheaper or 5% more expensive?
I told you, I said, you're repeating my words. I said no. I mean, that is not the point. This is a limited point which Yash was making, that for insurers, is there a cost to be absorbed? That's all.
Yeah, I think for media it is important not to focus on limited points and focus on larger points.
Okay, Yashish, I'll still continue with my point.
We can focus on how will reinsurance cost change, how will we can go into all these details.
No, correct. So it's well understood by the industry, Yashish. Though it's big positive for policyholder, there is some cost to be absorbed by insurers, and maybe some of it will come down to aggregators.
And that benefit will come from the higher volume. I think what Umesh said was very relevant. I think we will all have a great Q3.
Yes, just Yashish, just one number very quickly. How much does health contribute to your value and revenue, and how much does term life contribute?
About 60% of our value is health insurance, and about 25% is term insurance. So these two products are 85% of what we do in terms of value. Also, 85% of our media spend is on these two products alone, health and term. So health and term, please appreciate, we have been in various government meetings for the last 15 years, always requesting that health and term have a separate carve-out. And we are really pleased that it has finally happened. It was like a baby who was making a noise. Nobody was like, it's finally been heard, which is very, very good.
I think also, if I could weigh in on the debate that you three gentlemen have been having, and I mean, as someone who tracks personal finance and has only the policy buyer's interests in mind, and we've seen this, happen day in and day out, that when that premium is, say, no longer 15,000 rupees and it comes down by 18%, the industry has a way of adding more goodies for the same price tag.
Absolutely.
So we've seen product innovation, we've seen reassure plans, we've seen plans which give you no capping on room rates. There is so much product innovation going on, and that someone which has gotten attuned to paying 15,000 maybe will still pay 15,000 for a better policy. And maybe that's what the market is also picking up on, and we'll see how that plays up. But Mr. Revankar, he's been very patiently listening into this spirited debate. Sir, just coming to you specifically, because this is such a big change and it's going to be an ongoing change. Revise our memory. When you talk about, say, consumer-facing finance, or, actual consumer finance for you, what percentage of your book would that be? And will the mix change in any way? When you talk about retail-level auto, or even if it is, because even on buses, etc., GST has gone down on everything. So will your lending mix over the next 2-3 quarters change in any way?
Yeah, there is likely to be some change in the lending mix. Maybe there will be more new vehicles will be financing, because some of these segments, some of them who are not really upgrading their vehicle, they may come forward. So I have seen in certain part of the country, many people are postponing the upgrading of their vehicle, either buying new vehicle or newer vehicle. So that momentum will come, and that should really create a better demand, credit demand. I see there will be a lot of change in the way people do business going forward, and better compliance itself will bring more business, because many more industries will not be happy to play safe with the compliance, and no, that will create. I think the MSME segment especially will get a very big boost, because there will be a lot of consumer item that has come into lower slab, and the consumption will increase, more compliance, more movement of goods. So I feel it is an extremely positive move to bring down this slab, make everyone comply, and grow the demand. I think sentiments will be very, very positive.
All right. Absolutely. One hopes that overall there is lots of savings and, this better affordability across the board, across sectors. And it shows up in different ways, as we've been saying, boosts consumption, which I think is the need of the hour. Yashish, thank you very much. Always spirited. Always great speaking with you. Umesh, thank you very much as well. We'll take a quick commercial break here. We're going to come back on the other side, and we'll get into some of the tax aspects, right? We want to clear some stuff. So MS Money of Deloitte India will be with us. Saurabh Agarwal of EVA India will be with us as well. Stay tuned.
Welcome back. Well, let's get into the taxation nitty-gritties now. We've got MS Money, partner GST at Deloitte, and Saurabh Agrawal, tax partner at EY. Gentlemen, thank you so much for joining in. Mr. Money, it's a landmark day, right? And we've been tracking and tracing the history and the evolution of the GST framework with you for so many years now. I want to straight away get to the biggest debate. And if you could hear the previous speakers, I think you'll already know that. The question is, what happens to goods or services that have been moved to either the 5% category or the exempt category, and they don't have the benefit of input tax credit? Insurance is obviously one such big space, but how should we look at it, and how should we interpret this, Mr. Money?
Okay, so let me first speak on insurance, because insurance is very different from all the other products and services which have been moved. As far as insurance is concerned, what we need to understand is that the overall input tax credits for an organization are across all policies, and there are only few expenses which may be in respect of specific policies. So here what has been exempted are typically health cover and term cover. Now, health cover and term cover may have a few expenses which are directly attributable to it, on which obviously there is no question of an input tax credit, but there would be a large amount of other expenses which would be common for the entire organization. And the debate is in respect of the proportion of those common expenses that pertain to the health policies and the term covers. When we do that calculation and when we do that math, and it may not be identical for each insurance company, the proportion of their health policies and the proportion of their term cover policies sold may be different. It may be different in respect of health cover sold by general insurance companies and health cover sold by life insurance companies. When they do that math, and I think it is a little too early for them to do the math because this has happened only last night, they will come across a proportion of credits that they may not be entitled to in respect of the common credits. Now, bear in mind, till now, we are not aware of anything in the 80-page press release that was issued yesterday, which says that there needs to be a reversal mechanism for the common credit, but that is expected in any case, to be there. Now, the proportion of credits that they need to reverse, once we have that number, is when this debate can actually have some numbers attributed to it. Is it going to be 2%? Is it going to be 5%? Is it going to be 8%? That number will need to be worked out. And as I said before, it will not be a uniform number. It will vary across the company depending on their product portfolio. But the larger issue is now all the insurance companies will now need to rework their products and go back to IRDA to get an approval of new products, because some of the old products cannot be sold after 22nd of September. So when they do that pricing, as was mentioned by one of the speakers in your earlier session, when they go back to IRDA, it's quite possible that the insurance companies bundle more services or more features in the existing products at the same price. And there may be some products where they pass on a larger part of the reduction to the customers. Right?
But net, to try and keep it simple, Mr. Money, in the current form, let's talk about a standalone health insurer. In the current form, because for a standalone health insurer, all the policies now go into exempt category. So will there be a hit or not? Because as of now, there is no input tax credit. There would be some cost that insurer would have borne to provide that service, on that premium. So will, say, a standalone health insurer in this case be entitled to anything, or what happens to the cost? Or will it just have to be either borne by the insurer or the distributor or eventually passed on?
You're bang on. So for a standalone health insurer, there will be a cost attributed to the exemption. There will be a cost attributed to the exemption. But when that cost is attributed to the exemption, the view is that, one, they might tweak the products and add some more features to the product. The second aspect which we have to bear in mind is, if a person is buying a policy which is costing, which has a premium of 1 lakh, and that product cost today to the customer is 1,18,000, because in real sense, the customer does not care 18,000 is GST or 10,000 is GST. The customer says, I'm paying 1,18,000 premium.
Yeah.
Now, this customer, if he even reduces the premium, and if the premium, let's say, comes down to 1,05,000, what's going to happen to the 13,000?